Good evening. This is Manuel Vargas with Keller Williams Realty Landmark 1 and 2 in Bayside, Flushing, and in East Elmhurst, Astoria. Today, I wanted to talk to you about capital gains as they apply to primary residence. Um, I found an article on Realtor.com that I want to share with you. It's written by Margaret Heidenry, and it talks about some changes because of the Tax Cuts and Jobs Act that took effect in 2018. So I'm going to talk about what the article says, and I want to make a full disclosure to you that I'm a licensed real estate broker. I am not a tax advisor. I'm not an accountant. I'm not a CPA. I'm not an attorney. So I'm not pretending to give you legal advice or accounting advice. I'm just going to share with you what the article says. And anything else that I may say, you take that as my personal opinion, not as an advice. Thank you very much. So what are capital gains? Capital gains are taxes that are levied on possessions and property, including your home, that you sell for a profit. If you sell this home in 1 year or less, you are subject to a short-term capital gain. If you sell your property and you own it for 1 year, for over a year, you are subject to long-term capital gains, and there is a preferential treatment to this gain for the longer term. So there is a difference if you sell for 1 year in 1 year or less, short-term capital gains, or if you sell in more than 1 year, long-term capital gains. Most of the people that own a house to live, they don't move sooner than a year. That's very rare. It may happen, but they don't move in less than a year. So most of the people would have that have a primary residence and live there for more than a year, they may have long-term capital gains. Okay, and we will explain what the rates on these long-term capital gains are. Then the article talks about the primary residence tax exemption. Basically, every person is entitled to an exemption or an exclusion in capital gains taxes of $250,000, right? If you meet certain criteria, it will be $250,000 for a single person, or it will be $500,000 for a married couple, that own a property where they live. What are the requirements that you have to meet to qualify for this exemption, right? Number one, the home must be your primary residence. So this means your secondary home wouldn't qualify for this exemption, or your investment property wouldn't qualify for this exemption. So number one, this home must be your primary residence. Number two, you must have owned this property for at least 2 years. Number three, you must have lived in it for at least 2 years out of the past 5. What does this mean? Number one, you must own this property for 2 years, right? If you own it for less than 2 years, you don't qualify for this exemption, right? And number three means that you must live in this property for 2 years out of the last 5. So looking at the last 5 years, you have to have lived there 2 years out of the last 5, not necessarily the last 2 years, right? And number four, you cannot have taken this exclusion in the past 2 years, meaning you can only do this process every 2 years, after 2 years. You cannot do this, for one property now and do it for another property right away. You have to wait the 2 years for each property, right? There is a provision where if you don't meet all of these requirements, you may be able to take a partial exclusion for capital gains tax if you meet certain exceptions. For more information, the article states in a very subtle way, please consult a tax advisor or IRS publication number 523. Okay, so if you don't meet all the 4 requirements, you may qualify for a partial exclusion, not for the whole thing. What are the conditions for that? For that, you have to talk to a tax advisor or publication number 523. Okay, What are the capital gains rates? And this is where the uh, Tax Cuts and Jobs Act, which took effect in 2018, changed some things. So for capital gains above this exemption that you may be entitled to, above 250,000 for a single person, or 500,000 for a married couple filing jointly, above that exclusion, you will be paying capital gains taxes. What are the rates? And we are talking for Uncle Sam, meaning federal tax rates. What are them? Okay, for single folks that make 40,000 or below, the capital gain taxes would be 0%. So for those people, single filers that make below 40,000, no capital gains on the amount beyond the exclusion, the 250,000. For people, single filers that make between $4,000 and $1 and 441,000, the rate is 15%. And for single filers that make above 441,500, the capital gains is 20%. So 0%, 50%, and 20%. That's pretty easy to remember. If you make 40,000 or below, 0%, over 40,000 up to 441,500, 15%, and above 41,500, 20%, 0, 15, and 20 for single filers. What happens to married couples that are filing jointly, right? What are the limits? What are the tax limits? The tax rates, the income brackets or the income limits are as follows. For a married couple that make 80,000 or less, the tax rate is 0%, so no capital gains taxes. If the married couple makes between $80,000 $1 and 496,600, the rate is 15%. And if they make more than 496,600, the rate would be 20%. So the rates would be 0, 15, and 20%, like in the example for the single filer, but the income amounts, the income margins are slightly different. 80,000 or below, 0%. 80,000 $1 and 496,600, 15%. And beyond 496,600, 20%. This is for a couple filing jointly, married couple filing jointly, right? And then it says that the capital gains taxes for very high income earners are a little bit different because they may be subject to an additional 3.8% net investment income tax. For these higher earners, then you should check with your accountant, okay? What about home improvements? How do they reduce your capital gains taxes? The article talks about your adjusted cost basis. So the cost of your home is what you paid for it. Your adjusted cost basis is what you pay for it, plus your improvements. You know, what improvements can you take into account? Basically, capital improvements, not maintenance, like painting, not repairs. Repairs are something that you do because they are needed, they are necessary to keep the house running. What you can count to calculate this adjusted cost basis are improvements such as a new kitchen or a new bathroom, right? Not repairs, right? So a new roof would be a capital improvement. A leak, you know, as stated by the article, would be a repair that wouldn't affect your cost basis. So for example, if you bought a house 20 years ago for 200,000 and you spend 100,000 in improvements, your adjusted cost basis is 300,000. If you sell this property for 550,000, your gain would be 550 less 300,000, 250. If you are a single filer, you're entitled to an exclusion of 250,000. You wouldn't be paying any capital gains, right? So this is the concept of your adjusted cost basis that you add to the price you pay for the asset, you add the cost of your improvements. This is your adjusted cost basis. Therefore, they reduce your capital gains taxes. There are certain closing costs or settlement clause, both when you buy the property and when you sell the property, that increase your cost basis, meaning they're going to reduce your capital gains. For the details on this, you should talk to your accountant, because some closing costs, as understood in general, some of them, they don't increase your cost basis. Some of them are deductible the same year that you buy the asset, but some of them increase your cost basis, so you can talk to your accountant. Same thing when you sell the asset. At the end, certain settlement costs like transfer fees or broker's fees, they increase your cost basis, meaning they reduce your capital gains taxes, and you should talk to an accountant about it, right? But keep in mind that concept that you cannot take into account maintenance or repairs. It's only improvements, and certain part of your closing costs when you buy or when you sell, they will add up, they will influence your cost basis, therefore reducing your capital gains taxes. What about inherited homes? If you inherit a home, we have the concept of the stepped up basis, meaning that you don't pay taxes on the gain since your parents bought it. You pay taxes on the gain from the day the last parent died to the time you sell it. That's called the stepped up basis. So if the home is worth $1 million when your last parent passed, the gain would be calculated starting $1 million. That's the stepped up basis, right? Important to remember if you inherit a home. What about loss when you sell your property? Well, it is important to know that the article says that in a primary home, you are not entitled to any deduction if you lose money selling your home, right? If it's an investment property, then yes, you can look at it from that point of view. But if if it is your primary home, you are not entitled to deduct anything because you are losing money. Then to finalize this discussion, to remind you again that we are talking about primary residences. If you are selling an investment property, different rules apply, and there is a certain procedure that you can use to defer your taxes. The article talks about how to avoid capital gains tax as a real estate investor. I think this is very ambiguous. This is confusing. The article shouldn't be saying how to avoid, but rather how to defer, because there is a process called a like-kind tax exchange, 1031 tax exchange, that investors use to defer taxes, not to avoid them. So I don't want to talk about it here because this is more for investors. I was trying to inform home owners that live in the property and they use the property as a primary residence. And because investors are a little bit more sophisticated, they do this for a living, and there are concepts there that they would understand better. So to summarize, the tax rates have changed and the regulations have changed since 2018. There are certain income brackets that apply. They apply, we are talking about mainly primary residence. Also, to take into account the improvements when you sell, they add up to they increase your cost basis. Also, when you inherit a home, there is something called the stepped up basis that counts capital gains from the day the last parent died. And then to understand that you are not entitled to any deduction if you lose money when you sell your primary residence. This counts only, or this applies only for investment properties. Thank you very much.